Hi and welcome. You're listening to the X22 Report. My name is Dave and this is episode 933A, and today's date is March 31st, 2016, and the title of the episode is The Economic Collapse Continues. U.S. companies announce the most first quarter layoffs since 2009. Now, when we look at the market, we see the market has been bobbing up and down. If we go back to January 2016, we started out the year way down, and they pumped the market back up, and we've been in the green. We've been down in the negative area. Gold, same thing. And they're just trying to keep the system completely stable. Now, I was talking to someone today, and we were talking about the market, and they were telling me how the market, and many people believe this, that the market shows how the economy is doing. It's the gauge of how the economy is doing. And I said, really? Does the market actually really tell us how the economy is doing? Because if we go back in time, we can go all the way back to 1929. The stock market was at all-time highs. And at that point, everyone thought, yeah, the economy's doing well, there's no problems. And then one day, in October, the market came crashing down. When we look back at 2008, we were at all-time highs of, 14,000 points or so? People thought, whoa, look at the economy. It's doing fantastic. The market's up at 14,000. Everything is fine. The Fed is telling us everything is fine. The U.S. government is telling us everything is fine. Everything's contained. Nothing to worry about. And people went about their business. And all of a sudden, one day, in October, all of a sudden the market crashed. And all of a sudden we hear from many companies saying, oh, hey, it looks like it's time to start laying off some people here because the economy's not doing well. Well, the economy just didn't switch on a dime here. What was happening all prior to this was that the economy, every single day up to that point, was slowly deteriorating, getting worse and worse and worse. Because what these central bankers do is they continually pump up the market any way they possibly can. Of course, it's better when they get the American people involved in their bubbles. This way, it's a better crash for them, and they don't have to create money like we saw them do. Actually, I say create currency like we saw them do after 2008. Because prior to that, they were able to get the American people into real estate, into purchasing items, and they were able to continually pump the bubble up until the very last moment in 2008. This time, the problem was the American people are completely tapped out. They don't have the funds to push the bubbles to new heights. Now, in some areas, like student loans, like auto loans, they were able to create these bubbles. Now, remember, these loans are not the people's money, not the people's currency. They're borrowing this. And if the government or the central banks allow people to borrow, no matter if they're in subprime, people are going to do it. And of course, this is not your savings. This is a loan. And we see a lot of these loans are becoming delinquent. A lot of the people that have gone to college, graduated, can't find jobs. Their loans have been modified. But for other parts of the market, like retail, manufacturing, housing, the people are sitting on the sidelines here because they're getting laid off. They can't find the full-time job that they once had with the same pay. And they're very nervous about the future. And we can see that from the Gallup poll, where they're saying that economic confidence has fallen. If we look at the government poll, it shows us that everything is fine. But when we look at this, we can see why the central bankers loved to have the participation of the American people in their bubbles. It makes it easier for them. After 2008, since they didn't have the participation of the American people, what did they have to do? They had to create them by printing currency. And they had to do a lot of this. And they had to give it to banks. They had to give it to hedge funds, investment companies. The interest rates were very, very low, so they could use this money in all different areas. And like buying thousands upon thousands of homes, renting them out, holding on to them. Banks would take the money and they would put it into the market after the Fed came in and bought up their toxic real estate, and they were able to pump up the market with this free money. They make a profit, they return the money, no interest, everything's good to go. And we can see the difference here. Before 2008, the people were included in the bubbles. After 2008, it's the central bank that's creating the bubbles. Yes, there are some foreign investors involved, but mostly it is the central bank that is creating these bubbles. This is why they can't do anything with the retail market. This is why we see stores closing. This is why we see people having problems finding jobs. These are certain things they can't do. Yes, they can manipulate the numbers. They have the ability to do this. But what we're seeing right now is they don't have the ability to touch certain markets. And this is why we have such a disconnect today. This is why people don't understand what is going on. They can touch the stock market. They can touch precious metals. They can touch GDP, unemployment, statistical numbers. They can't touch reality, though. That's the main problem. They can't touch reality. And what I mean by this, they can't touch the physical market of retail. They can't all of a sudden give free money to a bank and say, you know what, go out and purchase as much as you possibly can from all the stores around the country. It just doesn't work. Real estate, they can say, listen, you hedge funds, you investment companies, take this free money, buy up thousands of houses. Banks, don't foreclose on a lot of the homes, keep them off the market. Let's drive the prices up in 20 cities. It's a lot easier to do that. And with GDP, they can manipulate those numbers, but they can't explain why manufacturing is declining, because they can't have factories produce. They just don't have the ability to do that in reality. And this is why all of this is disconnected at this point. This is why people are having a problem taking what is happening and understanding, because they're looking at the stock market, they're looking at the statistical numbers. But everything else, reality, the central bank just can't touch at this point. And this is why we're seeing the real economic indicators, what's really going on, what's really happening, and the illusion. And these two things are moving further and further away. And as they move further and further away, it's going to be much harder for the U.S. government central bankers to keep the illusion alive. And they know this. They understand it. And this is why they're rushing. This is why they're in overdrive at this point, because they have a certain period of time before something might happen that might just bring the entire system down. Let's get right into the economic collapse financial news. Now, yesterday we talked about the Eurozone, and we talked about how the consumer confidence has dropped, and we're at the lowest level in more than a year right now. S&P came out, and they're discussing the Eurozone, how the economy is doing, and they have a warning that Europe's key economy is now flying on one engine, which is quite scary when you're in a plane. Because if that engine goes out, you're done. And this is what we're going to see at this point. Because nothing has improved. Nothing has changed. Yes, we're seeing little dead cat bounces in certain areas. Things have to pick up sometimes and then they drop off once again. Because you have to remember, the world is still operating. Stores still order things. There might be less of the things that they're ordering, but what they do is they deplete whatever they have, and then they put in a smaller order, and we see a bounce up of all manufacturing. We see a bounce up of maybe the Bolton-Dry Index and things like that. But then once again, what happens is, okay, I have what I need, and they no longer order. Maybe people aren't purchasing at this time, so we go a longer period where everything starts to decline once again. We never get back to that period of where everything is okay. And when we look at unemployment, we realize that as more and more people lose their jobs, we're going to see less purchasing in retail, less manufacturing. The Baltic Dry Index will most likely drop once again. And this will continue because what we're seeing right now is that unemployment around the country, around the world, is moving upward, where more and more people are losing their jobs. And we can see that the ISM manufacturing and the services employment indices, they've collapsed. We're seeing endless headlines of layoffs. Challenger Gray and Christmas are noting that the first quarter of this year in 2016 was the worst since 2009. And we see for the third week in a row, this is the longest streak since July of 2015, the last 3 weeks have seen a 9.1% surge in jobless claims. This is the biggest rise since April 2014. And we have to remember how this is done. You know, all those retail people who are losing their jobs and they're working under a certain number of hours, like 25 hours or so. Each state is a little different, where they might have 30 hours, some might have 25, and they're making a certain dollar amount. They're not counted as layoffs. Oh no, they had a part-time job. We're not going to count them. But if someone gets that part-time job, they're counted as having a full-time job in the unemployment statistics. And this is how they manipulate a lot of this information today. And this is why people are very confused. Now, through the first quarter of 2016, employers announced 184,920 job cuts, up 31.8% from the 140,000 that they saw back in 2015 at this time. So what we're seeing right now is that the number of layoffs is growing, and it's getting worse and worse. BlackRock is laying off 400 people. BAE Systems is laying off 170. BP in Houston, 500 plus. And we continually see more and more layoffs. And they're getting closer. They're getting larger. And you know what happens when the market comes crashing down. Companies go all out and say, okay, now we got to clean house because we're admitting there's a problem and we need to lay off people. This is what happened in 2008. All of a sudden, we saw everyone being laid off. We're going to see this again. What they're doing is they're trimming down right now. They're doing what the central bank wants. Get rid of the people, lower your costs, take those funds, buy back your stocks, pump up the market. And this is what we've been seeing. It's the same cycle. Now, we know revenue, we know sales are all down in these companies. So the market at this point is completely manipulated with buybacks, with banks stuffing money into the market, with high-frequency trading, plunge protection teams. This is not an open free market. This is a manipulated market. Now we see the Chicago PMI. It has jumped back to 53.6 in March, which is better than expected, but remains below the January 55.5 highs. And we can see every time we have a bounce up, we have a bigger bounce down. And we can see with the Chicago PMI, this is what's been happening since the middle of 2014 or so. And we can see that the central bank, they do whatever they possibly can to keep this economy alive and keep people in the dark, keep people in the illusion. And we know that there are certain areas they can do this, and certain other areas they just cannot, because they just don't have that type of control. But the main thing they control is the stock market, and a lot of people look to that. And this is where they want people looking. And we know that this is not an indicator of anything. This is an indicator of manipulation. We see the Baltic Dry Index has climbed to 429, up 15. Still way, way below where it's been since like 1985. This is horrific, actually. And most likely, this is going to drop once again, because we can see what happens. People come in, the stores, the companies have their inventories. They draw them down. People still want certain things. They have to order more. We see a little bump up. They order more, and demand continually drops down. The ordering becomes smaller and smaller and smaller, and we end up crashing. And this is what we've been seeing. And believe me, when it gets around 500 or 490 or 525, the corporate media most likely will say this is the new normal now. If they mention it at all. They might not, because it's so low. Still, even at 600, it is really, really low compared to what it was when we were in a booming economy. Now, JP Morgan Chase, they have shaved the first half of this year, their GDP estimates, by 0.5% because of weaker durable goods. That's like washers, dryers, those things. And they're also saying that consumer spending is way, way down. Remember, they include Obamacare in consumer spending. If we strip Obamacare out, and we know Obamacare, the Affordable Care Act, has very high premiums, and this is why they like to include this in consumer spending, because it makes it look really good. Like, ooh, people are spending again. Well, if you strip it away, actually people are not spending at all. And this is quite evident in malls, with the stores closing down, with people being laid off in retail. And we've had thousands and thousands of stores closed. We're seeing a contraction in stores. Now, just because you see people in malls using their credit cards doesn't mean that everything is fine. People will even when they're bankrupt, they'll just continually spend. Because a lot of people don't like their lives to change at all. They believe that everything is going to get better, so I'll just keep spending, and everything will be fine. It doesn't show you that this is a strong economy. If people paid with their currency and not with credit, I would say, okay, if everyone's paying with currency from their savings and they're able to make more and continue the purchasing, I would say, okay, we have a strong economy. But if you're just buying things on credit, then getting another credit card and buying more, and then getting another credit card and buying more, that's not strength, that's debt. Because eventually what happens is it grows so big you can't sustain it, just like the U.S. government. There's no difference here. And we see right now that JP Morgan Chase, they're estimating that GDP is going to be around 1.2%. They thought it was going to be at 2%. And they're saying the second quarter, that most likely will be 2%. Now, if you go back to 2015, they said 2016 was going to be the year when the U.S. economy takes off. Now, if you go back in time, they said this in 2014 for 2015. They said this in 2015 for 2016. Now they're saying it for 2016 for 2017, that 2017 is going to be the year that the economy takes off. If you notice, the central bank, the IMF, and all these predictions, they're always wrong. Actually, every time they say it's going to be better, if you notice, GDP has been sliding and declining. It's doing the opposite of what they're saying. And from everything that we've been looking at, this is why everyone should take a look at all this data and say, this is what happened in 2008. Now it's much, much worse. Maybe I should prepare. And this is what we've been following, the deterioration of the economy. And every time we look at this, it declines and gets worse a little bit at a time, while the stock market goes up. Whoa, hey, didn't we have that in 1929, 2008? And look what happened. The same thing's happening now. So get your food, Get your water, get your weapons, get your gold, get your silver, have cash on hand, get your medical supplies, get your toiletries. Make sure you are prepared. Make sure you're ready. Get batteries, flashlights, whatever you need. You don't want to be in that scenario where people are running to the market. I mean, just look at other countries when this happened. People were running like crazy to find food, water, supplies, because they knew there were major problems. If you're doing whatever you're doing, prepping, continue to do it. Do not stop. You can go to lifereliance.com. They have water, they have bug out bags, they have seeds, they have water filtration systems. You can customize your order. But wherever you're doing this, it doesn't really matter. Keep doing it. Get prepared. Because what we're seeing right now is that the real economic indicators, the reality, everything is sliding and declining. While the central banks try to continually convince everyone that everything is fine. Now, they've lied to us many times before. Why would you believe them now? I know I don't. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.